So today we will understand fair value area and order blocks. So now we know in the market price is always moving. So price always moving from one PD array to another PD array. So at any given time what price is doing when moving from one PD array to another PD array? It is either seeking a liquidity or offering fair value. That is what we always know. So one of it is seeking liquidity. What is liquidity? Liquidity is at swing high and swing lows. What about offering fair value? It offers a fair value. To offer a fair value, when in a trend, price always goes in one direction, but price never goes in one direction in a single straight line. It always moves from one PD array to another PD array with little retraces. So as per in this diagram, in a bullish trend, when price moves up, it moves up, reaches some PD array like a bearish fair value gap or a swing high, the price can retrace a little bit. When it retraces, it is offering a fair value. Whom do we offer the fair value? So when price is moving in one direction, only buyers are involved. There, so buyers got involved. So by offering a fair value, market gives a fair chance to the sellers. Once the market has offered a fair value, price again can start in the original direction or it may continue in the direction of a retrace. It depends on where the liquidity is or the market conditions or the market sentiments. But overall, once the market has offered fair value, price can continue in the original direction. Now, once price crosses the last or the previous swing high or swing low in case of bearish fair value areas, once price reaches another PD array, it can retrace back to the previous swing high. So this particular red area is the area where price can retrace, because in this area price market has already offered a fair value. So after moving up, price can retrace only up to this point, or it can enter little bit inside the previous fair value area and again continue in the same direction. Now at this point, price has two options. It can either continue in the same direction of the trend, or if it retraces deep inside the previous fair value area, that means now market is not offering fair value but it is seeking liquidity. So what liquidity? Where is the liquidity? It is at swing lows. So it might be offering seeking liquidity at this swing lows, this or this, if the retrace is deep inside the fair value, right? This is about the bullish fair value. So how the fair value area can be located on a chart? So in our we have seen the fair value gaps is a 3 candle pattern. Initial candle, first candle could be anything, second candle is expansion candle, third candle is again anything, could be anything, it could be consolidation, expansion. In this case, where it is a fair value gap, we have this consolidation, wherein the close of the third candle is below the high of expansion candle, and we have a gap between first candle's high and third candle's low. So now if there is a swing high overlapping with this swing area, this fair value area, it constitutes the fair value area, right? It can also be termed as order block based on the conditions. If this area could be the order block as well. So after reaching the high point, we are offering fair value here by tapping into this wick, and then again continue the price high, or it may continue lower based on the market sentiment, market conditions. Let's dive into a real-time gold chart. This is a daily time frame chart for gold. Here we can see price has moved higher, retraced little bit, again started its journey, bullish journey, then again retrace. Now if you see, the retrace is up to the last swing high. After retracing to this last swing high, price has continued its bullish journey. So there was no reason for price to come back down because this fair value was already offered. So after offering the fair value in this area, price has continued in the bullish trend direction. After that, it again retraced to this previous fair value area and then started consolidating. Now here, after this, price has not followed the original direction, probably because we are at little bit all-time high. So price might be consolidating, or it can continue higher or lower based on the market sentiment, market conditions, or political conditions, you can say nowadays. Let's see how bearish fair value area looks like. So in a bearish trend, when price moves down after reaching some discount array like the bullish fair value gap or swing low, price can retrace. It can retrace to premium array like bearish fair value gap or fair value or the bearish order block to offer a fair value for buyers to get involved. For buyers to get involved, because when price was going down, sellers were actively involved. By offering a fair value, market is giving buyers to get involved. Once fair value is offered, price again can continue in the original trend direction. Once it reaches another PD array, it can again retrace till this previous swing low to offer fair value and continue the direction downward journey again. In a bearish scenario, how does it look like on a chart? So we see on bullish trend, in a bearish trend we have this fair value and a swing low overlapping. So it constitutes the fair value area. When this price taps into this swing low, we have offered the fair value. After offering fair value, we can see the what next candle is doing and accordingly take a decision if price is continuing downwards, consolidating, or it's reversing. Let's dive into the daily dollar time frame to find out the fair value area. In this scenario, price is moving consolidating, then it reached the lower price swing low and it started bullish journey. Then it returned again to the previous price level and is started to go up. It failed to do so and then started consolidating, and ultimately it caused a deeper retrace into the previous fair value area. This particular area is a fair value area. Now price is starting to trace deep into this fair value area, right? So let's understand what is order blocks. So what is order block? In a simplest form, definition is in an uptrend, a single or a series of down candle swept by the bullish candle, or in a downtrend, Single or sequence of up candles swept by a bearish candle is an order block. To be a valid order block, it must be originated from a PDRA. It also must generate a new PDRA, like in a fair value. It must generate a new valid order flow leg. Now, what is order flow leg? That we will see in the coming videos. But for now, let's understand order flow leg is movement of price from swing low to swing high or of swing high to swing low with an fair value gap in that leg. Okay. Let's see in the chart how order block can be seen or can be identified. So in an uptrend, when we retrace little bit to offer a fair value, this can generate give rise to a order block. So this down candle in an uptrend, this down candle, one down candle or a series of down candle can create an order block provided it generates a new fair value gap and this order block itself is coming off of an PDRA. Let's see in this gold chart how the order block is, this bullish order block is created. Why this is a bullish order block? It's a sequence of 3 or 4 candles which is giving rise to these two fair value gaps. It is coming off of an PDRA. It is creating a swing high. So this is a valid order block. This order block give rise to this order flow line. Once price reaches some PDRA, price has tested this order block and continuing its journey in the original direction or price can move as per the market conditions. So this is an bullish order block. What is bearish order block? In a downtrend, when price retraces, it can create an order block provided it creates a new bearish fair value gap downwards and these order blocks are generated from the PDA. Let's see this dollar chart for bearish order block. These two up candles in this downtrend give rise to the bearish order block. Why it is an order block? Because it is creating this new fair value gap in the downtrend and these two green candles are coming off of this fair value gap. So it is generated by this fair value gap and generating this new fair value gap. So this is an valid order block candles which is tested here and price continues the direction, downward direction. This is how the order blocks can be identified on actual charts. Let's understand different types of order blocks. The first order block is mitigation order block. What is mitigation order block? It's a swing failure pattern where price actually reverses. So it is a very strong price reversal indicator on an order block. So let's understand what is bullish order block or bullish mitigation block. So in a bearish trend, when price fails to reach the last swing low and changes the direction to be bullish by running up previous swing high, it creates a bullish mitigation block. What is bearish mitigation block? In a bullish trend, when price fails to reach the last swing high and changes the direction to be bearish by running down the previous swing low, it creates a bearish mitigation block. This is theoretical. Let's understand on chart the mitigation blocks. So this is a bullish mitigation block. Why it is a bullish mitigation block? Because we are in a downtrend and we have this retrace. After retrace, price is supposed to continue in the original direction of the trend, the bearish direction. But in this case, price fails to cross this swing low and changes the direction to be bullish by running over this previous this retrace swing high. Okay, like in definition, by running up the previous swing high, this swing high is run over. So in a shortcut we can say this is a W pattern. Some people call in W pattern as well. So here the price reverses and continues in the bullish direction. In that case, these down candles becomes the valid order block. So this order block is then tested. Let's see it on the chart. So gold is on bearish trend, and after retrace it fails to run down this swing low and continues the journey upward. So these four bearish candles constitute an order block. This order block is then revisited, tested, and price continues original direction. This is the entry, mitigation block entry for a trading. Similarly, let's understand bearish or mitigation block. In a bullish trend, price retraces and then tries to continue in the original direction but fails to do so and runs down the swing low and changes the direction to be bearish. So this is called as a bearish mitigation block. Let's see it on the chart. Let's see this Bitcoin chart, daily chart, wherein we reach the top higher level, we retrace little bit, then we price again started to continue in the original direction but failed to do so and run down the previous low. Now this previous low overlaps exactly with this small fair value gap which is tested here. This is the perfect bearish mitigation block entry to take a trade. This retrace, not this retrace. Why? Because this is a mitigation block, mitigation order block, bearish mitigation order block, which get tested here. This is a bullish mitigation block which is tested here. These four candles and these three green candles are the bearish mitigation block. Okay. Let's move on to the next order block, which is a breaker block. Now, what is breaker block? It is also called as failed order block, which causes price reversal. This is also a very strong price reversal order block. What is bullish order block? Bullish breaker block. So bullish breaker block is actually a failed bearish order block. So what is bearish order block? Like we can see in this is a bearish order block. When this bearish order block fails, it gives rise to bullish breaker block, right? In a bearish trend, when bearish order block fails to run down the last swing low and just sweeps it and continues in the opposite direction to be bullish, it creates a bullish breaker block. What is bearish breaker block? It's a failed bullish order block. So in a bullish trend, when bullish order block fails to run the up last swing high and just sweeps it and continues in the opposite direction to be bearish, it creates a bearish breaker block. Let's see it on the chart. This chart, if you see this dark gray area, this is a bearish order block. Price are moving down, little retrace, continuing in the original direction. This is a valid bearish order block. However, when this price just sweeps this low and continues in the reverse direction, the direction of the retrace, then this order block is failed. This bearish order block is failed. So it becomes a bullish breaker block. How? Let's see this chart. Price is moving down, then it retraced with these two green candles. We retraced, it again went down, but after sweeping this low, price has reversed the direction. So these two candles become bullish order block, which can get tested here, where we can enter the market to reach the all-time high. Similarly, this in this bearish breaker block, this dark gray area is nothing but a valid bullish order block. Price is moving up, little retrace, the red candles, and then continuing in the original direction. But instead of continuing in the original direction, we sweep this low, this high, swing high, and continue in the direction of a retrace. So it becomes a bearish breaker block, which will get tested later on. Let's see it in the chart. So in this dollar index, dollar chart, what do we see? We are consolidating after a bullish trend. Here we went high, we went low, we went high again, and after that we are moving direction of retrace. So these red candles becomes the bearish block, bearish order block, which get tested here. This could be a valid entry to reach the target. Thank you.